In this session, we're going to cover an important concept called bootstrapping. Bootstrapping in business means that usually a company kickstarts its operations without using outside resources or without using, let's say, venture capital. In this case, bootstrapping, the way we're explaining it here, is really using customers as main investors inside the company, meaning that a bootstrapping company, instead of focusing too much on acquiring a venture capital, is going to focus instead on how to acquire as many customers as possible and really build up what's called organic growth. So instead of pumping money into the customer acquisition process, which is usually what happens when you are a venture capital funded, as the venture capital is going to require you to grow at a very important pace so that you can give them the return that they're looking for. So the even paid acquisition channels need to be in tune with the very fast growth of the company. When it comes to bootstrapping, instead, you start by looking at customers and understanding how you can grow organically your business. And from there, use the cash flows to actually reinvest them into the business, and therefore the cash flows will become the investments that will enable you to grow the business and therefore make it more viable from there. So from there, build a business model that based on the customer's feedback can grow and become more viable as you use the cash flows here to reinvest them into the business. And that's how you can attract better customers, intended as customers who are more in target with your customer, with your service and product. And that's how you actually bootstrap a company. Again, here the main difference is that a bootstrapping company usually uses customers as a way to grow the operations of the business. It doesn't necessarily look for growth which is non-organic, which doesn't mean that the growth doesn't have to be fast. In some cases, also organic growth after a certain threshold can become very, very quick, very, very fast. It can pick up very quickly, but at the same time it's more based on acquiring customers who are in target with business rather than growing for the sake of burning the capital, the growth capital that has been allocated by venture capital. So the venture capital model is based on capital that is allocated to the startup, and this capital needs to be used and allocated for growth only. Instead, in a bootstrapping process, the process starts by attracting customers, and the cash flows generated by those customers, by those accounts, is used and reinvested into the business to build a more viable business model and attract better customers over time.